Basis risk is the risk that the price of a hedging instrument will not move in perfect correlation with the price of the asset being hedged. The word basis refers to the difference between the spot price of the asset being hedged and the price of the futures contract used to hedge it. It is the risk that a hedge will be imperfect, leaving a residual unhedged position that can result in unexpected gains or losses for an institution. This was notably illustrated during the 2021 to 2023 LIBOR to SOFR transition, which generated substantial unintended exposures for many financial institutions. A perfect hedge, where losses are exactly offset by gains, is rare because assets and hedging instruments are almost never identical in maturity or quality. In futures markets, the theoretical relationship between spot and futures prices is driven by the cost of carry model, including financing and storage. This relationship creates conditions like Contango, where futures exceed spot, or backwardation, where the spot price is higher due to income generation. Actual basis converges towards zero at the delivery date, but the unpredictable path of that convergence is the primary source of basis risk. Commodity basis risk arises when an airline, for instance, hedges jet fuel using crude oil futures. The two do not move in perfect lockstep. Geographic basis risk occurs when local cash prices in one region differ from the delivery location specified in a futures contract due to transport costs. Interest rate basis risk is practically significant when a loan references one floating index while the hedge references a different reference rate. Yield curve basis risk occurs when a hedge protects against movements at one point on the curve, while the exposure is sensitive to another point. Credit basis risk arises in credit hedging when the credit default swap references a different seniority level than the actual debt exposure being hedged. Fixed income managers retain exposure to credit spreads when hedging bond portfolios with Treasury futures, especially during periods of market stress. The DV01 of the hedged position and the hedging instrument must be carefully matched to minimize risk arising from duration differences. The cheapest to deliver option embedded in Treasury futures is another source of basis risk, as the effective duration of the contract can shift. While basis risk cannot be entirely eliminated, it can be managed through careful hedge design and identifying closely correlated instruments. The optimal hedge ratio accounts for differences in price sensitivity and historical correlations, rather than relying on a naive one-for-one ratio. Monitoring the basis continuously allows the hedger to adjust positions or roll the hedge into more actively traded near-term contracts as needed. Basis risk is distinct from model or liquidity risk, though all three compound to determine the overall effectiveness of a hedging program. For your exams, remember, basis risk is the risk of an imperfect hedge. It can be minimized through optimization, but rarely eliminated in practice. Core points to retain. Basis is the spot futures difference. Common forms include interest rate and credit risk, and instrument selection is critical. This script was written, verified, and approved by compliance professionals at financial regulation courses. Good luck with your examination.